If you've been eyeing a $400,000 house and wondering if you could afford it, this video is for you. We're going to talk about the formula that the lender uses to approve you, about maxing out what you can qualify for versus a comfortable monthly payment, and how much residual income you need to have in order to qualify for a $400,000 house. But before we do that, let me introduce myself. My name is Linda Shinpaw, and I am a licensed loan originator powered by Edge Home Finance Corporation. And we are the #1 national mortgage broker in the United States. All right, the first thing you need to know is about this debt to income ratio. This is the formula that all lenders are using in the background, right? And if it's a conventional FHA, VA, or USDA lender, then these are standard ratios. So what you need to know is that we're going to look at your monthly debts and we're going to divide them by your gross monthly income. Okay, monthly debts. What are we looking at? We're looking at things like car loans, student loans, credit cards, personal loans, mortgages, alimony, and child support. These are things that are going to appear on your credit report. And what we're going to divide by is that gross monthly income. Okay, that's a lot of words, right? Isn't income, Linda? No, not really. Gross monthly income, if you're a W-2 employee, is the income you receive before taxes are taken out and before any deductions. All right, it is the big number on your pay stub. That makes it a consistent playing field for everyone because, you might take 10% out every paycheck for your 401k. I might only do 3% or nothing. And there's all kinds of other variables that can come out of your paycheck. So gross monthly income, the big number, is what we're using. Now, what we don't care about when it comes to the debt to income ratio are monthly debts like your rent payment, groceries, utilities, gas for your car, cell phones, and health insurance. These are not counted in that debt to income ratio. All right, let's talk about a real world example because you clicked on this video because you're curious how much money you need to make to buy a $400,000 house. All right, the example we're going to use is you have an income of $120,000 a year, which is $10,000 a month, okay? I have lots of clients that come to me in this situation. Maybe they are, they're professionals in their community. They might be self-employed and own a small business, but no matter what the situation, this is an example I see all the time. If you make less than this, it's okay, right? We can do the same math and apply it to you and come up with the sales price that works, all right? But for this example, for $400,000 home, this is where we're going to start. All right, $10,000 a month in income before taxes, before deductions. Then we're going to look at your debts that we have to include. And in this example, the borrower has a car payment of $850 a month, credit cards that total $250 a month in minimum payments. So when you get your credit card statement and it says you owe $35, but really your balance might be $2,500, on your credit report, what we see is the monthly minimum payment. So I have to add all of those up across all of your credit cards, and that's what will count against you. Okay, so in this example, that would be $250. And then my family likes to RV. We travel all the time. And so I put an RV loan on here of $375 a month for this particular client. And actually, one of my girlfriends really has a scenario very similar to this. So like I said, I try to share things with you that are very realistic. What I'm not going to care about and what I'm not going to include is the fact that this person is paying rent of $1,750 a month because that rent's going to go away when they buy the new house and the new mortgage is going to take its place. I also don't care about the utilities of $225, nor do I care about your cell phone bill of $145. Okay. Now listen, just because I don't care about those things, you do need to take that into account when you're establishing your monthly budget. And we're going to talk a little bit more about that in a minute, but this is just for the debt to income purposes. All right. So what's the fine print here? Well, the fine print is that every loan program has a different set of guidelines that we have to play by, which means you could get a different answer as far as how much money you would qualify for on a loan for conventional FHA, USDA, or VA loans. Okay, so every loan program has its own set of guidelines, its own set of rules that we have to play by. It's like when you want to go play basketball or volleyball or pickleball or whatever game that you like to go play and hang out with your friends, right? Whoever's in charge might have slightly different rules, right? When Joe's in charge, it's, you can do this. And when Steve's in charge, there's a few extra rules or whatever. Just think about it like that. Those loan programs are like your friends who kind of layer on their little special rules to the games you like to play. There are also some other risk factors like your credit score and reserves that you have. There are all kinds of things that play into the approval process, okay? I'm keeping this example very black and white, but I want you to know that your overall credit profile, how much money you have in the bank, 401ks, things like that, these things do strengthen and weaken your position when we're getting approvals, okay? So this next section, hang in there with me. There's some of you that want all the details. You can't get enough. And there's others of you that are like, Linda, just give it to me, give me a high level overview, but I want to understand. So we're going to go through this quickly and hang in there. There is something called a front end ratio and a back end ratio. Front end debt to income ratio, back end debt to income ratio. These are things that we look at, okay? All it means is the front end debt to income ratio is simply your new mortgage payment divided by your gross income, the big number on your paycheck, okay? And then the back end ratio is your new mortgage payment plus your monthly debt that we talked about on the prior slides divided by your gross monthly income, okay? So front end ratio, only looking at your new mortgage payment. Back end ratio is looking at mortgage payment plus all your other monthly debt that we have to count. And then there are some percentages that we need to stay under in order to get any kind of an approval, right? So you can see here, conventional doesn't really care about your front end ratio, but they do care that we stay under a 50% back end total debt to income ratio. FHA is a little more lenient. For your payment, you can use up to 47% of your income. And for your payment and all of your monthly expenses, we can get approval sometimes up to 56%. USDA is 34 on the front, 46 on the back. VA only cares about the max debt to income ratio. And they're the most lenient. We have gone into the 60% range and gotten approvals on these loans. I'm not saying that you should do that. I'm just telling you what I've seen. And there's kind of an industry benchmark that if you want to be really safe and make sure you have plenty of money for the other things that are going to come up outside of your mortgage payment, that you would stay around a 28% front end ratio, so for your mortgage payment, and a 36% back end ratio for the mortgage payment and total debt. So if you guys like numbers and want to go really deep, you can take these and crunch some numbers for yourself. But we're going to move on. Okay, so let's do a real world example. Let's keep it going. I got my little chalkboard here on my chart, if any of you remember the chalkboards. So we're going to look at the conventional loan, and I'm going to do the 50% max debt to income ratio, the back end debt to income ratio. It's easy math. Let's do this, okay? So our income was $10,000 a month. If we can use 50% of that to put towards our total monthly debt, including the new mortgage payment, then $10,000 times 50% is $5,000, right? Okay, that's not scary. We can all do that math. Awesome. Now, this tells us this is the portion of our income that we can now use for the new mortgage payment and all of our other debt. So the first thing we do is we subtract out the knowns. We know from our prior slide that we had a car payment, we had credit cards, and we had that RV loan, remember? And that was $1,475. So all we're going to do is we're going to take the income that we now have to use towards all of our monthly bills, $5,000, subtract out the total debt of $1,475. And now we have roughly $3,525 left over to put towards this new mortgage payment, okay? This is the little like on the napkin at lunch kind of calculation, but this is how we think through the process, right? Every situation is going to be unique. It is going to depend on your credit score, your credit profile, reserves, the things I talked about. I just want to say that again, but this is the math, very simply put. Okay. All right. So now how do we figure out, supposedly we have a little over $3,500 left over, but do we really, can we really buy that $400,000 home? Let's take a look. Before we continue with a little more math, let me just remind you, or maybe teach you for the first time, that $3,525 has to include all of the portions of your monthly payment, right? The biggest part of your payment is going to be principal and interest, and that's this turquoise color in the pie graph. All right, principal and interest, and that's repaying the loan. But there are other components that we have to factor for and that your mortgage company will collect for each month as part of your total monthly payment. Okay, so principal and interest is going to pay back the loan. Then the green little piece of pie is called PMI. That's private mortgage insurance. If you don't put 20% down, you're going to pay private mortgage insurance on a lot of the loan types out there. There are some exceptions, but we're not going to go there right now. Okay, but just know that it's an insurance policy that the lender takes out to protect themselves in case you or I were to default. And again, if we put less than 20% down, we're going to have PMI. Then HOA, that just stands for Homeowners Association fees. So if you buy in a condo or a townhome community, or even a lot of neighborhoods have some sort of HOA fee, we're going to need to include that. HOI is homeowners insurance, right? Property insurance. You got to have that. If you're getting a mortgage, you're getting homeowners insurance because if something catastrophic were to happen to the house or you have any kind of damage, you and the lender have to be protected. And then finally, property taxes. And I did leave this box or this part of the pie a little bit bigger because typically you will see your property taxes be more than insurance and so on and so forth. Every situation is unique. Of course, there's different parts of the country and different phenomenons. But what I want you to understand here is that when you get a mortgage, you're not just paying back the loan. There are additional fees, and this is how it adds up. All right. So back to our example, back to our chalkboard. We're going to do conventional 5% down. Again, very normal loan. I see these all the time. Say the purchase price is $400,000, right? That's why you clicked on this video. If we put 5% down, that means you're putting $20,000 down and you have a loan amount of $380,000. Okay. Now I'm going to give you three very simple principal and interest payments at three very straightforward interest rates. These are by no means any rates that I could promise you today, tomorrow, last week, next week, right? The market is always changing. And I go back to what I said before, every situation is unique, right? We'd have to pull your credit and do all kinds of other things. But this will give you an idea of if a $400,000 house works for somebody making $120,000 a year with the debt load in this example. So on a 30-year fixed mortgage, which means that you have the same interest rate for 30 years and that principal and interest portion will not change. Just the principal and interest would be at a 5% interest rate would be $2,039 and change. At a 6% interest rate, it would be $2,278 and change. And at a 7% interest rate, that would be $2,528 and change. Okay, so we said we had just over $3,500 to put towards this monthly payment. And you can see that our biggest payment in the scenario is just a little over $2,500, which would leave you about $1,000 to put towards taxes, insurance, PMI, and homeowners association fees. And in the 22 years that I've been doing mortgages, I would feel really confident saying to you in this example, you're going to be just fine. Okay, we can get this done. Now, I got to give you a little bit of advice. I gave you this example at 50%, which is like a max debt to income ratio for conventional financing. It was easy math, right, guys? But I don't want to see you just maxing out your payment just so you can get the most amount of house possible, right? That isn't always the best answer. First of all, You don't want to be house poor. Okay, you don't. And if you're buying a house for the first time, you know, like the life that you're living right now, right? What activities do you like to do? What does it cost, right? Maybe there's fees to be a part of what you do. Maybe you have to travel, or you get to travel and you want to, continue to do that. You know, what do you like to do with your friends and family? Vacations, or just going out every Friday night for a bite to eat and hanging out with everybody. Maybe you like to buy season tickets to something. So don't be house poor just because we could approve you for X amount, right? I also need you to be thinking about, you get a budget for repairs and maintenance. When you're renting, a lot of times, my husband and I used to own a lot of investment properties. And in our rental agreements, if something was $50 or less, the tenant took care of it. But if it was more than that, then they were supposed to call us. And so maybe you're in a similar situation where, you just call the landlord, or you call there's a janitor's, number that you call if there's something wrong in your apartment or the house you're renting. But when you buy this house, if the circuit breaker blows up, if the heat doesn't work, if, the fans quit working, whatever it is, you need a budget for that. And you don't want to be putting that on a credit card and being all stressed out and strung out. And certainly if you did have a major repair come up, you'd want to be able to make it. And then the last thing I want to say is that, lenders are just applying formulas to borrowers most of the time, right? There are a few of us that, like, I genuinely care about you understanding this information, right? Like, the most important question that I will ask you and the most important answer you will give me is, what is a comfortable monthly mortgage payment for you? What do you want to write the check for? What do you want to set the electronic, auto payment up for each month? What is a comfortable monthly payment for you? So if you have talked to a lender who's like, hey, we got you pre-approved up to this amount of money, and they haven't had any of those conversations with you, and they haven't shown you what the monthly payment could look like in that price range, then you're not working with the right person. All right. So lenders are applying these formulas to all borrowers. We have an automated underwriting system that the underwriters use, that we have access to. If we get great information from you, we can pop it in that system and we can give you a great answer back. But all of that is for naught, again, if you don't want to write that check or set up the auto draft for that amount. So please, please, please make sure you're saving for a rainy day, and that you can do a lot more things than just live in your house at this point. All right. If you need more information, I would love to help you. I have a smart homebuyers guide that is for free. And so you can click the link in the description, or you can go to yourhtlender.com, and there's some colorful buttons you can click on. I'd love to share that with you. I will stay in touch with you. I do a weekly email to my database, and I'm sharing all kinds of mortgage tips and credit tips, and explaining things that might happen randomly in the news. I speak simply. I want to make mortgages easy. And I think you can tell that from the way that we had this conversation. I would also be thrilled to jump on a planning call with you. There's a link below for a 15-minute call. I know you're busy, but let's at least connect for 15 minutes and see what questions you have and what you're stuck with. And if we need some more time, we'll make it. Or if I can point you in a direction in that time frame, I will do it. But again, my goal is to make mortgages simple and easy to understand. I hope that you found this video helpful, and let me know in the comments below what other topics you'd like to hear about. Hope you have an amazing day.